Hi, I'm Adrian. I run a YouTube channel called Passive Income Investing where I discuss everything from my personal portfolio to new funds coming to the market with a special focus on income-oriented funds and much more. And I'm very excited today because I'm here with Global X to explain what covered call ETFs are, how they work, and why income-focused investors like myself use them. They might be the strategy you've been missing. So what is a covered call ETF? Well, first off, let's cover the basics, everyone. An ETF, or exchange traded fund, is a basket of stocks or other assets you can buy and sell on an exchange just like a regular stock. A covered call ETF holds a portfolio of stocks just like any other equity ETF, like an index fund, for example. But what sets it apart is that it also sells call options on those stocks that it holds. So a call option is a financial contract that gives the buyer the ability or the right, should they wish, to purchase a stock at a set price, also known as the strike price, within a certain time frame, also known as the expiration date. So this could potentially generate additional income called an option premium for us, the investors. So how does a covered call ETF actually work? Well, think of it this way. Imagine you own a house, but you don't use it all the time, so you rent it out on weekends to earn some extra cash. Well, covered call ETFs do something very similar. They rent out the right or privilege to buy their stocks to other investors in exchange for a fee, which is passed on to you as income, as the investor, right? So in layman's terms, basically, when you're selling a covered call, or in this case, the ETF is doing it, you're potentially giving up some upside for that extra income, for those premiums. Of course, there's a trade-off. When you sell a call option, you're essentially agreeing to sell the stock at the strike price the option was written on. So if the stock takes off and rallies past that strike price, you've capped your upside potential. You won't get the full benefit of that stock price rally. For example, if a stock is at $100 a share and you sell the call option with a strike price of $105 a share, you will miss out on the upside past $105 during the contract time frame. In markets that are sideways, choppy, or even slightly down, a covered call strategy could potentially outperform over just holding those same stocks outright. I'll get into that later. First, let's talk about Global X covered call suite. Global X offers one of the largest covered call ETF suites in the country, with strategies across different sectors, international equities, and even fixed income. Global X Canada generally uses a short-term, out-of-the-money strategy. That means they're writing call options that expire in about 2 months, and typically at a price that's a bit higher than where the stock was when the option was written. For example, if a stock is at $100 a share, let's say, and you write the option on $105 a share, it's out of the money. 5% out of the money, to be precise. This approach does two important things. It generates consistent option premiums, your income, but still leaves room for some stock growth, so you're not entirely capping your upside. They also don't write calls on the entire portfolio. Typically, they'll write on a certain percentage of the holdings, for example, up to 50%. So this keeps a balance between income generation and growth potential as well. Some of my personal favorite Global X covered call ETFs that I personally hold in my portfolio are USCL and QQCL. You can check them out in the link in the video description below. How do covered call ETFs perform in different markets? A covered call ETF can be useful in a variety of different scenarios. In bear markets, for example, it may outperform. The option premiums you're earning can help soften the blow by offsetting some of those losses. In a sideways market, it could often be traditional stock investing as well, because you get to keep collecting option premiums even if prices aren't moving that much. The trade-off, though, is that in bull markets, when things are going really well, covered call ETFs might lag behind. The option will be executed at the strike price, so you won't get to experience the full run beyond that price. However, you're still earning income plus any dividends and some growth. Long-term investors should not try to time the market. Covered call ETFs are about positioning for steady income and reduced volatility, especially if you're in or near retirement or just looking for yield in uncertain times. So to wrap up, a covered call ETF is a tool that can help you generate income while staying invested. They could be amazing tools for many income-focused investors, including myself. Global X Canada offers one of the broadest suites out there, covering broad indices like the S&P 500, the S&P TSX 60, the Russell 2000, and even the MSCI Emerging Markets Index. Also, sectors like Canadian banks, oil and gas, or even commodities like gold. So if you're interested in learning more, I highly recommend reading up on their website. If you're interested in income investing, be sure to check out my channel, Passive Income Investing, where I specialize in income-focused investing, especially covered call ETFs. The links are down below. Plus, there's much more investing content coming out here on the Global X channel every single week, so make sure to subscribe to stay in the know. Thanks for tuning in.